I'll give you a simple example of a momentum strategy so that the listeners can understand what it is. So let's say we have a group of stocks of CNX 200 stocks. So we have the top 200 stocks, and we may look at the rate of change of price over, let's say, the last 11 months, for instance, and rank all of these 200 stocks basis how much each stock has moved in the last 11 months. Now that there will be a ranking from 1 to 200 based on this particular aspect itself. And I'm just taking a very simplified example. Our strategies are slightly more complex than this, but just for understanding. So we now have a top 200 ranking, and let's say we take the top 20 stocks out of this ranking, the stocks that have done the best in the last 11 months in this 200 stock list. And we've taken top 20 stocks and allocated 5% of our portfolio to each of them to start with. Now, at the end of the month, a month later, we will again do this exercise and see where these stocks stand now. So some of the stocks which were in the top 20 may slip down to 30, 40, 50 positions, and other stocks may have come up now. So what we will do is we will let go of the stocks that are no longer showing strength and add the stocks which are now in our strength list, in the top list. And this is how the stocks which are, over time they weaken, get eliminated, and the ones which are stronger come into the fold. And that's how, the drawdowns remain limited, because you are not waiting on any stock to really bleed deep before you get out of it. You are allowing the, this ranking method to get to the strongest pack amongst that particular group and staying with the strongest pack. It can, of course, happen that the entire market goes down. Like for instance, the entire market went down in March 2020 in the pandemic crash. But then what happened was that stocks that were the least impacted came into your fold. So, stocks which were defensive in nature, FMCG stocks, pharma stocks, IT stocks, those were the ones in which your portfolio will automatically move to. And then once the market started to pick up again and the higher risk stocks, risk-on stocks started to do well, the portfolio strategy automatically reverted to metals or the autos or even mid-cap IT stocks, so on and so forth. So this is a very automated sort of a self-correcting mechanism of staying with the winners while you are losing the losers at all times. So the impact of this usually is that in a year you will have a few stocks that are multi-baggers, a large number of stocks that have done in line or slightly better than the market, and very few stocks which are really done badly. So on an overall basis, you will see that you are outperforming the benchmark, because the benchmark is comprised of, let's say, 200 stocks, out of which 50 or 70 or 80 will not perform. They will actually go the other way. But because the index is made up of those 200, it is a compilation of all the 200, whereas we are, through the mechanism, picking most of the time the strength in the market. So the performance in these strategies is usually much, much better than the benchmark because of this reason.